Good evening, everyone. In the panel discussion that was happening before this session, there were three wise men on the panel. They made some very interesting points. One thing that was important was the difference between trading and investments. Most people think that trading and investment are difficult things to do. Some people are good at trading, some are good at investing. But it is the rarest of rare who are good at both trading and investment. Rakeshji was one of the geniuses who was great at both trading and investing. But the good part is, he never mixed trading and investing. There were two different compartments, not just financially, but even in his mind. He was very clear. We don't trade in what we invest, and we don't invest in what we trade. I'm going to be talking to you today about investing. I'm going to be talking about some very softer elements that go into investing. This is not going to be about what P ratio to buy at, what P ratio to sell at. It is not going to be about what to buy, what to sell. The idea is to share with you the crux of investing as we have learnt it, as we have understood it. So bear with me if it is a little nebulous. Feel free to ask questions. And we'll request you to try and understand what I'm trying to say in its entirety. Okay? So here I go. There's this famous quote. There are two most important moments in anyone's life. One is when he or she is born. Second is when he or she realizes why. Realizes why they were born. Right? That realization of why they were born, that is an insight. From that point on, it leads to crystallization. It leads to clarity. Clarity of purpose, clarity of thought, clarity of priorities. In the same way, in investing, having that insight is very important. It is a necessary condition, but not a sufficient condition. What do I mean by that? It means without having that insight, to make fantastic returns in investing is not easy. But even after having that insight, you may still not make returns in investing. Why? Because there are some other characteristics which are necessary. I'm trying to share today those characteristics and the importance of that insight in investing. Investing is this process, right? You have to buy something, hold, and then eventually sell. This journey could be 1 year, 2 years, 5 years, 10 years, or maybe more. It's a simple journey. However, this journey, each step of this journey has multiple elements, multiple challenges. When you are trying to buy, it looks like the world is ending. It looks like this is not the time to buy. It may look like this is not the price to buy. It may look like the other stock is better. How do you get the clarity that this is what I should buy? How do you get the conviction that I must buy this and I must hold this? How do you get the patience to do that? So, I will be sharing with you some of the drivers of each step in this investment journey of buy, hold, and sell. First, to buy. And let me share with you that most of the elements that I'm talking about are from a book called 100X or 100 Baggers. Okay. To buy a long-term investment, you do need two things. You need conviction and you need courage. Sometimes you may have the conviction but not have the courage. Sometimes you may have the courage but not have the conviction. For those who may have practiced Vipassana meditation, you will realize that there are two elements, awareness and equanimity. If you have awareness, but you don't have equanimity, you will have wild mood swings. If you have equanimity, but don't have awareness, then that's a state where ignorance is bliss. We don't want either of those two states. Same way, to buy, you need both courage and conviction. But how do you get this courage and conviction? What is the root cause of this courage and conviction? I would like you to think about that. So, let me ask you a question. Can I request the gentleman in pink on the first table here? Yes, sir. What is the best stock that you bought in your life? Best investment that you made in your life? Which year? Have you sold it? So you held it for so many years. Excellent. Right? So, why did you buy it?
Scooter business was doing very well under the leadership of Mr. Bajaj. And business was growing, means exponentially year by year. I was getting bonus and dividend. Those two factors were there. And FII entered, I think first script they selected was Bajaj Auto. And subsequently I got means on division of Bajaj Auto, Bajaj Finance and Bajaj Finserv.
When you bought that stock, did you buy 10 other stocks?
Yeah, definitely.
Have you held the 10 other stocks to date?
Maybe 2 or 3, yeah.
Okay. So in the process of investing, you need skill, but you also need luck. Don't let anybody tell you that luck does not play any role. However, luck is not a random event. Luck also comes to those who deserve it, who position themselves in a way that luck comes to them. It may not come when you want, but it will come eventually. So, to take this example, he bought Bajaj Auto so many years ago and did not sell. At that time, he bought 10 other stocks. However, those other stocks may not have done as well. When he must have bought Bajaj Auto, it may have been hypothetically 5% of his portfolio. But over a period of time, Bajaj Auto may have become 25% of his portfolio. And all the other 10 stocks may be much smaller. Consciously or subconsciously, he bought because of two things. With whatever reason, he had the conviction to buy Bajaj Auto, and he had the courage to buy Bajaj Auto at that time. However, what was the root cause of his patience to hold Bajaj Auto from 1993 to 2023? 30 years. There must have been some root cause of that conviction and that patience. Please think about that. In these 30 years, there have been at least 6 big bull markets and 6 big bear markets. But you held through all of that volatility, through all the mark-to-market gains, through all the mark-to-market losses. Why were you able to do that? To do that, you surely needed both patience and equanimity. If mark-to-market losses trouble you, you won't be able to continue to hold. If you don't have the patience, you won't be able to continue to hold. Like Sunil gave an example of Bajaj Finance, right? He sold it at 4x, but after that it became much more. But that happens when you are holding the right stock. If you bought the wrong stock and it goes up and then you don't sell it, it can go down to 0 as well. We've seen quite a few of such examples as well. So, after buying the right stock, you need patience and equanimity to continue to hold it. It is rare. Rakeshji bought a stock called Karur Vysya Bank in 1993. And we are still holding it, just like him. So, In your journey of investing, if you have the courage and conviction to buy, and then patience and equanimity to hold, more than half the battle is won. But that is assuming that you bought the right stock. When do you sell the right stock? Is there a time to sell the right stock? And how do you sell the right stock? So maybe we can speak to the gentleman in a quote on the first table. Yeah. Which is the stock that you've sold and after holding it for a long time and made a lot of money, but you regret having sold it? Could you speak a little louder?
I haven't sold a lot of stocks because then I started working as an equity research analyst. So no trading was allowed. So I've been made a lot of money in Vinati Organics.
In?
Vinati Organics.
Okay. And you haven't sold it yet? No. Okay, good. Maybe the gentleman next to you, if you have sold stock and made a lot of money?
The same stock, Vinati Organics, I've sold and I'm regretting it right now.
Sorry?
Same stock.
Same stock. And you held it for how many years before you sold it?
So 15 years.
15 years. And after selling it, did you regret it?
Yes.
After selling it, how many times did it go up?
Went by 600, 700 rupees. 6 to 700 rupees.
Okay, how many times of your selling price?
It would be 30%.
Okay, that's all.
Yeah.
Why did you sell it after making so much money in 15 years?
No, I had a requirement, so I have to sell it.
Okay. If you did not have that requirement, would you have sold it?
No,
Okay. When would you have sold it, if at all?
I think I would have passed on to my next generation.
You would have passed it on to the next generation. Fantastic. So, the components of selling are important. If the reason that you bought it for, if that reason is invalidated, we call it the hypothesis. Hypothesis is the reason to buy it in the first place. And if that hypothesis is broken, for example, if in that company there is some corporate governance issue or some capital misallocation issue or a quality of earnings issue, then you will sell. Irrespective of whether you are making money or whether you are losing money, because your hypothesis is broken. You may also sell if there is irrational or insane valuation. If you bought a stock at maybe 20 times earnings and it goes to 40 times, it's not necessarily insane. Market is giving that higher multiple maybe for a reason. But if it goes to 100 times earnings, you will surely have to question whether it is irrational or not. The third possible reason to sell is what we call as relative long-term opportunity. If your courage and conviction to buy some other stock is far greater than the one that you are holding, then that could be a reason. These are the three reasons to maybe sell. Assuming that there are no financial requirements to sell. One is hypothesis fails. Second is insanity or irrationality. And the third is relative long-term opportunities. We are only discussing long-term here. However, each of these three sets of drivers for these three decisions of buying, holding and selling have one common ingredient. What is that? Any guesses? Okay, let me give you a hint. The gentleman who wrote this book, 100x, he used these words. He said, you must have the vision to see, the courage to buy, and the convictions to hold for you to be able to buy 100x. He used the word vision. In addition to the words that I have used. Any thoughts now on what is the common ingredient amongst all of these drivers? Okay, let me share that with you. That critical ingredient is what we call as differentiated insights. Okay. There are two words here, differentiated and insights. Let me first dwell on the word insights. The meaning of insights is that you have an understanding of something that is superior to those around you, but which is also right. So there used to be a fund manager called Peter Lynch. He used to, I think, be part of Fidelity, and he used to meet all the top management teams of most of the companies. Once, he had gone to the mall along with his wife for shopping, and his wife bought a product known as legs. They were stockings. He observed that and asked his wife why she bought it. Listening to that, he figured that his wife is going to be a loyal customer of this product for many years. Based on that, he bought that stock. Not on the basis of his management meeting, not on the basis of his number crunching, but on that insight that this product is able to generate intense loyalty among its target customers. So, you don't need to be a financial expert to get that insight. You can get that insight in many different ways. If he had not had that one insight, he may not have bought that stock. Or even if he did buy that stock, he may not have held it for so many years. When you look upon your own investment journey, I'm sure you will find that one point which made all the difference in your mind for your decision making. However, most of us are very busy doing too many things to be aware of that one point. It's not a new point, it's not something that you don't know. It is something that you know. But you have to raise your awareness levels such that you can recognize that one key point in your mind, that one insight. That insight not only gives you the conviction to buy, it also gives you the courage to buy, irrespective of whether there is a crisis in the market, irrespective of whether the market is going up or going down, irrespective of whether your friend has told you about some other stock which is going to give you 30% return in 1 month. There is that one thing in your mind which makes you have the conviction and the courage to buy that stock. That is the insight. It is that same insight which also gives you the patience to continue to hold. It is that same insight which gives you the equanimity to continue to hold even if there is a lot of volatility in the market. Markets may go up, markets may come down. You could have a limit down on that stock on some day, but you will not panic. You will not panic because in your mind you have that differentiated insight. You will not panic and sell because you become insecure about, oh, this stock is already 3-4 times for me, let me book profits and run. You may not know how many times this stock is going to go up, but the direction will be clear in your mind. You may not know the destination, but you do know the direction. And you know that direction because of the differentiated insight. Even if you have to sell that stock, you will be better at selling the stock. You may not catch the top, doesn't matter. But you will be better at selling the stock when your hypothesis breaks. Because you know what the hypothesis was when you bought it. You know if that one crucial factor has changed or not. When you think of relative opportunity, even to think of relative opportunity, you need to realize whether the insight relating to this stock is better than the insight relative to the other stock. Hence, for every factor here, you need complete clarity on that insight. Now let me come to the second word, differentiated insight. Why is differentiated important? When Peter Lynch bought that stock, it's not as if his wife was the only person buying that product, right? I'm sure many other customers would have bought it. They did not get that same conviction because they did not get the same insight. In his mind, what was important was not just the fact that his wife bought that product, but that he realized that she was loyal to buying that product for many years. So these are some very small things that matter a lot. When I was in school, and sometimes I might play some mischief, my teacher would give me remarks in my calendar. And what was written on top of that page in which she would write those remarks was little things that matter much. Since then, I've realized that it is the little things that matter much. Always focus on those insights. However, just because you have insights, will you keep making money? In addition to these insights, there are some additional structural factors which are essential. These are what I call as structural enablers. No matter what conviction and what courage you have to buy a stock, and no matter what patience and equanimity you have to hold it, if you have bought that stock on leverage and the market goes down and you get a margin call, you won't be able to hold it. So, having access to long-term, unlevered capital is very important. Whether that capital is a lot or not so much, doesn't matter. Whatever capital you have access to, if you are investing, try and compound that, but don't try to lever that. If you lever it, you will end up compromising your long-term returns. Because even if you make money at that time with the leverage, the next time that you take leverage, you may not make money, you will lose money. Even if you make it 5 times, the 6th time you will lose money. So access to unlevered long-term capital is important. If you have access to this long-term unlevered capital, then the next thing you need, apart from differentiated insights, is what I call as a risk-reward framework. There is this gentleman called Michael Mauboussin. He writes a fantastic set of articles which is currently called the Consilient Investor. He says investing is a probabilistic exercise. You have to weigh your decisions with probability. That is part of this risk-reward framework. You have to understand the probability of your decision going right versus the probability of your decision going wrong. You have to realize that if a stock is 10% weight of your portfolio, you will make decisions on that stock differently. If the same stock is 50% of your portfolio, your anxiety levels will be much higher. Your decision making will be weaker. However, if after developing all the courage and all the conviction, if you make that stock 1% of your portfolio, then even if you make it 5x, it's not going to have a big impact on your portfolio. So having a probability adjusted and probability weighted portfolio is very important. It makes all the difference to your portfolio. So for the gentleman here, Vinati Organics is what percentage of your portfolio? And yours? Okay. Why did you not make it 40%? Give him the mic.
The stock price went too high for me. I bought at 46 in early 2000, 2003, 2004. And I sold at 1800.
Right. So you made 40x, right? So even if the stock had doubled, and then if you had bought it, you would have still made 20x,
Yes.
right?
Yes.
Why did you not add to your position?
I did not have the courage when it started going up.
Right. Tell me, when you bought it at 43 rupees, right?
46.
46. What percentage of your portfolio was that stock?
This was my first investment actually.
So what percentage of your portfolio?
100%.
Only 100%. Okay. And by the time it became, let's say 5x, what percentage of the portfolio was it?
It was almost 8 to 9%.
8 to 9%. And when it became 1800, what percentage was it?
I didn't check exactly.
Approximately, your gut feel.
I don't know, frankly speaking.
Was it more than 20%?
Might be.
Right. So, the point I'm making here is, if that stock had become 50% of his portfolio, his insecurity about his portfolio and about the gains of his portfolio would have been far greater. So at all points of time, having the differentiated insights combined with a risk-reward framework, which is probability adjusted and probability weighted, is crucial. And the last two, focus and discipline. I met this friend of mine who has a stock portfolio which has 82 names. So I asked him, how do you build the conviction to buy so many stocks? He said, I have the conviction to buy 82 stocks. I said, how do you have the patience to hold 82 stocks? He said, I have the patience to hold 82 stocks because I have the conviction. I said, how do you build conviction in 82 stocks? He says, I do a lot of research. I said, out of these 82 stocks, how many stocks have you sold in the last 12 months? Guess the answer. He had sold more than 24 stocks out of 82. I said, where is the conviction and where is the patience then? So, a high churn rate of the portfolio is not a sign of conviction, is not a reflection of differentiated insights. If your top 3 portfolio weights are, let's say, 5%, it does not reflect that conviction, that courage, that patience, and that equanimity. I truly believe in this concept of gorilla investing. And you will see why. In a jungle, there are many monkeys, but very few gorillas. In a jungle, the life expectancy of monkeys is less, but the life expectancy of the gorilla is much more. You will see many monkeys flocking together. You will not see many gorillas flocking together. So, gorillas have greater longevity. Gorillas are much more rare than monkeys. And gorillas have leadership attributes. When you do find that gorilla, it has to be a meaningful portion of your portfolio. Let us assume that you made that gorilla in which you have conviction and you have the courage to buy that gorilla. You make it 10% of your portfolio, hypothetically. If your bet is right, then over the next 5-10 years, that 10% of portfolio will go to 20-25% of portfolio. How much insecurity you have about the returns that you've already generated, how much anxiety you have about the fear of losing the returns which you've already generated, that will be determined by these factors. How much focus you have, how much discipline you have, and what your risk-reward framework is. Excuse me. So, this focus and discipline is not something that is taught. What can be taught is the importance of that focus and discipline. But that focus and discipline is something that each one of us has to cultivate. What you need for that focus and discipline is a lot of introspection, is a lot of self-belief, is a lot of conviction and faith. If you have these elements, trust me, you have the foundation for having a fantastic journey in investing. However, please realize that the buy, hold and sell is not related to only one investment decision. Your portfolio is a series of investment decisions. So time and again, you have to keep iterating this journey. Time and again, you will make mistakes. And time and again, you will learn from those mistakes. You have to evolve as an investor. And each decision is interdependent on the other decisions. No decision is a decision in isolation. Hence, no investor is a one-stock wonder. One stock may have made all the difference in his portfolio, but for that investor to have that one stock which makes all the difference in his or her portfolio, you need to undergo multiple iterations of this process. These are skills and capabilities that you develop not just by repetition, but by learning. Mr. Narayan Murthy of Infosys used to tell us that I recruit my leaders not because of their capabilities alone, but because of their learnability. As an investor, our journey of investing is always filled with learnings. Irrespective of whether you lose money or you make money in that investment decision, you will still learn either way from every single decision. With that, I am open to questions. Thank you for your patience.
Investments in securities market are subject to market risks. Read all the related documents carefully before investing.